How's it going, everyone? Welcome to the sweep. Getting started just a little bit late today. I had a pressing appointment that I had to wrap up before the session, so I appreciate you guys hanging out. All right, let's go ahead and get started. So, as always, like, share, and follow on social media. You guys know the links. Pause the video if you want them. I'm going to push through this because we're already 3 minutes behind, so I apologize. All right, trade of the week. This week we're going to cover half top, so let's go ahead and get right into that. I actually got some marked off like we usually do. Let's really quickly, let's go over the parameters of the half top, because you'll notice this week it's just one sheet, right, one flashcard. So all we're looking for in the half top is going to be in our TNT indicator, this indicator right here. And what we're looking for is the thick orange line to be flat with the value of 50. If you're on our new version of Green Chart, it'll be a value of 5. So it'll be flat with a value of 5 or 50 if you're on the charting software. Now, the best way to check to see if this line is true flat is if the value of the previous candle is also 50, because that would mean that this line is flat, right? It didn't move off of that value of 50 or 5, right? The only other parameter for this trade is the candle itself, and the color of the candle indicates the direction. So if the candle is red, then we're looking for a buy trade, a long trade. So the candle just moved down, okay? It went flat to 50. So the previous value on this green candle was 50 as it came up, or 5. And then as it came to this candle and came down, it stayed at 50. So the value stayed at 50, and it's a red candle, so then we buy. We take a long trade. If it's a green candle, for example, if it was this candle and it was flat at 50, then we take a short or a sell trade, okay? So we're going to look at some examples of that, but those are the parameters. Really simple trade, right? We're all about these really simple type setups when we're looking at a very systematic way of trading. And this is great for people that are just getting started, right? Any of these systematic ways that we've shown you are great ways to get started. For one, because when you back test, you want to make sure that you have very specific parameters. Okay, if there's any misconception or confusion as to what your parameters are, it will reflect in your back testing, right? And you want to have as good a data as possible. And so it's important to be very clear as to what constitutes a setup and what does not. So in this case, if this was 49.99999, that would not constitute a half top, right? Or if this was, say, like a doji candle, you know, like a candle where it starts about the same place it ends, that may not be a good example of a half top, right? Because there's no body from which to determine if it ended green or red, right? So whatever those parameters might be, make sure they're very systematic and they're uniform so that when you back test, you know, yes, this is my setup, or no, it's not my setup, or maybe, and maybes are no's, right? And you can take notes on the maybes and you can see how they worked out so that, you know, if you have data to support including whatever that maybe parameter is, then include it. But to begin with, you want to just be very clear and concise as to what your parameters are. So let's look at that, because we're actually going to talk about something else other than the half top today, but let's look at our trade setup of the week. All right, so right here, if we're looking left to right, we can see on the euro versus US dollar, we have an example of that half top. We've got it's flat with a value of -50. Now notice if I go back just one candle, again, see this value right here, as this thick orange line came down here, its value is 50, -50, right? And then I go forward one candle, and now it's still -50, which causes for it to go flat. and it's a green candle. That's why we have this red pylon, because it's indicating sell or short, right? So for today's exercise, our goal is going to be just 5 pips for stop loss and 5 pips for take profit. Again, there's no science or math as to why we're using these parameters. It's just a goal for us today. In order to determine what your stop loss and take profit would be, you'd back test that, right? Because each currency pair moves differently and at different times a day. So without me actually knowing what times you trade, what currency pair you're going to be trading on, what setup you're going to be trading on at that time and on that pair, there's no way for me just to give you parameters. That's not the way it works. And believe me, people do it all the time. And believe me, it does not work. So if somebody just gives you parameters without knowing those specifics, or if they are referring to a specific time on a specific currency pair with a specific setup, and they say these are the parameters for that time, currency pair, and setup, then that's fine, right? Because they're already identifying those parameters. But I would still recommend you go and validate that. Go and test it for yourself to see that, yes, that is in fact the way it's going to play out. So there's no getting out of backtesting. As much as miserable as it might be for some of you guys, there's no getting out of it. You got to do it. Okay. So right here we're expecting a sell or a short trade. We're looking for a stop loss of 5 with a take profit of 5. So 1.21755 would go 1.21705. 1.21705. Let me take off that. 70, right about there, right there. And that's giving us a 10 and 5. I'm not going to use that tool. I thought I had it set up. Okay. Let's just click forward and we'll use our calculator tool to see which went first. Right there, it went down about 6 pips. 7.3 pips. It went up. We would have taken a little bit of heat, 1.3 pips, possibly, right? It could very well have gone down 5 and then gone up, but you can see there 7.3 pips. That would have been just fine. Here in the USDJPY, again, we got that half top. It's flat, value of 50. It's a red candle this time, so you can see we'd be taking a long or a buy trade, right? It looks illogical when we're looking at just a candlestick, but when we kind of paint the full picture, then we're getting better insight. For those of you guys that are more adept with, say, pressure or major minor, you can see that this would be very illogical, right? This is pointed down, and we're saying we're going to take a buy, you know, just even if it's just, and it may very well go down, right? But all we're looking for is that pop up to the buy side for, you know, just a quick scalp initially. And when backtesting this, I wouldn't go beyond 3 candles to backtest. I would say it's going to happen within the first 3 candles, and if it doesn't, then move on, right? Now, there are instances where it may go beyond that if it doesn't hit one of those parameters, and so you want to collect that information. Wait until you get to one of those areas, a 5 pip stop loss or 5 pip take profit, because there are instances where it'll happen in low volume times where we can see in certain currency pairs that the market may not move even 5 pips in one direction over the course of hours. So with that being the exception, you know, that could very well happen. When backtesting, you probably want to limit it to just 3 candles after that when collecting that information. Okay, so here we'd be looking for that long or buy trade, and right there it moved down only about 1 micro pip and then up 9.7. So that would have been just fine as well. Let's look at this next one, GBP USD. And again, we've got that half at 50. If we go back again, you can see that line is at 50 on the previous candle, which is why it goes flat, because it's also at 50 on this at the end of this candle. Right? These are 60-minute charts, guys. We're just using 60-minute charts for this example today. And so here we've got a red candle, flat, value of negative 50. We'd be looking for that long or buy trade. Again, very illogical. Look at these indicators. These are pointing down, right? So there are a lot of times where this would constitute a sell or a short trade. And there are other times where we'll do something different. It just depends on what the full picture looks like. And the more depth we get with the indicators and their output, then the more we're able to tell the difference between the two. So again, the indicators don't always aren't always telling us, you know, to sell or short when they're pointed down, or to buy or go long when they're pointed up. Not always, sometimes, right? Okay, but in this particular instance, looking at this specific pattern, systematic way of looking at it, we are getting the indication for a buy or a long trade. And that right there moved up 7.7, so good. It did move down 3.2. Can't really see the wick, the shadow down there, but it moved down about 3.2 and 7.7 up. So we hit our 5 and 5. Right here, USD Swiss franc. We got flat with a value of 50, and we've got a red candle. So right here again, we'd be looking for a long trade on the next candle or buy trade. Again, look, pointed down. This is sideways, so that kind of justifies some push in the other direction. And so is this one for that matter. But right here, you can see those are pointed down. Now, again, we're not looking at these indicators, the major, minor, the pressure. We're just looking at the thick orange and the candlestick itself and the value of the thick orange. Just so that we're clear here. But right here, we'd be looking for our long or buy trade, and that moved up 12.8 and down about 3.6. So we would have taken a little bit of heat. And again, our stop loss is 5 pips. So that had got really close, right? Within 1.4 pips of our stop loss if it didn't go up and take profit first. And it could very well have gone up, taken profit, went down, right? We're not going to replay them because I want to get to something else today. Here on the USDJPY, same thing. We've got a flat, and it's negative 50, and we're looking to take a sell trade. Now, one thing I do want to point out is that we have another setup that involves a flat, thick orange line, and it's called the flat top. But the value on the flat top would be 0 or negative 100. Well, it's flat. And then major and minor being in a certain position, right, overbought or oversold. So I don't want you guys to get confused by that one. This one's a little simpler because all we're using is the thick orange line and the actual candle itself. So right here, we've got that flat, negative 50, we're looking for, and it's a green candle, so we're looking for a sell or short trade. Oop, this one goes down 1.5, it goes up 4.8, almost to our stop loss, right? Maybe this is a loser, I can't remember if I marked out one. 4.9, that could very well have, depending on where you got it, if you got it in just a split second too early or too late, depending on what the next candle did when you got in, that could very well have lost, right? That could very well have just hit the stop loss and you would have been out of that trade, which is okay. It happens, right? It happens to everyone, and that's part of the game. Otherwise, it went down 11.6, and you would have captured that take profit. All right, last example right here. Again, we've got a flat, thick orange line, value of 50, green candle, so we'd be looking to short or sell, okay? And click forward. There we go. That one moved 9.3, drawdown of about 1.2. So that would have been just fine as well. Okay, so that's the trade of the week. The trade setup of the week is just a half top, something that we do send out alerts for as well. So for those of you guys that have already subscribed to our free alerts, you should be getting those alerts. If you're not getting those alerts and you've subscribed to them, it's probably because you haven't checked your email for our Slack invite or whatever the case may be. Maybe it got spammed or something. In any event, reach out to us. Email us, call us, reach out to us on some of our other forums, and we'll make sure that you get set up correctly. All right. Let's get to our lesson for today. So today we're going to talk about the pressure indicator. And our pressure indicator is actually the fastest predictive indicator in the industry. That is not an exaggeration. That is not my opinion. That is fact. It is the fastest predictive indicator in the industry. So, and we've talked about these analogies before, right? If you're going to make a prediction, you want to make sure that it is accurate. It's not enough to be predictive unless it's accurate, right? It's not always going to be right, but it's going to be accurate enough that you can count on it, okay? Now, what's interesting about the pressure indicator is that it looks like the simplest of our indicators, right? Of the 3 core indicators, it looks like the simplest, just 2 lines. But because of its subtle nuance and you know, the signals that it gives off are not as obvious as the other indicators, it's more difficult to read on a highly predictive level. Now, there are simpler ways to use it, and very effective simpler ways to use it, and you guys have seen us use it very effectively and simply in other systematic trade setups. But when we start talking about the convergence and divergence of the pressure indicator, it really comes down to its, you know, some of those very nuanced aspects of the pressure indicator. So pressure has the ability to see changes in direction faster than anything else, industry-wide. So when the direction starts to change, let's say the market is moving up, and then it's going to start to digress and maybe move down, even if it's just for a moment, right? Let's say we're in a downtrend right here, and so it's moving down and then up, and then a lot of times we can pick up when the pressure indicator is telling us, okay, it's going to start switching and go the other direction. And we'll use other indicators as validation as well to be as precise as possible with our entries, right? So it's within these subtle nuances of the indicators where these signals can be found. Or say, for example, we're in an uptrend and this was just a lull, right? We'll sometimes see some indications here that it's going to start going up. Matter of fact, if we look back to this, in this just picture right here, in this example right here, we can see that we actually got one of those. And we could actually see it right there as it narrowed on this red candle. And that was, and then, you know, especially when we look at combination of what the majors and minors were doing, right? That was giving us some notion that the market could be turning back the other direction. Okay. So when studying the pressure indicator, it's best to view it like a pressure gauge, all right? We don't always read a pressure gauge based on which direction it's pointed. We base it on what it's pointing to, right? So in the example, in this example right here, this pressure gauge, if it points up like it's doing, we don't assume it's indicating high pressure, right? Because it's pointing up, and when we think high or up pressure, then, you know, if this line is pointed up, then that would be the assumption if these were not present, right? If we didn't see that L and that H, if they were not there, we could make the assumption that this is high pressure, right? Because it's pointed up. Now, in a pressure gauge, like the example here, based on the layout, we conclude it is between high and low pressure. It's kind of in the middle of high and low pressure. But it's not pointing to the middle of the gauge. It's not pointing sideways. It's pointing up. And up, right in the middle right there, is right in the middle of low and high. So reading the whole gauge allows for us to determine where our pressure is, right? So here we see the pressure line indicating low pressure. And as it moves clockwise from this position, it is indicating pressure is building, but still on the low end, right? Because if it's going from here and it's going around to the high end, then pressure is building to higher pressure, right? But it's still on the low end of pressure, okay? Here, pressure is indicating high, right? Because it's pointing to the H. Now, as the needle moves counterclockwise from this position, it indicates pressure is dissipating, but still on the high side, right? So as it moves off of this and starts going the other way, then it's dissipating. It has less pressure, right? But it's still on the high side, so there's still some pressure on that end. So in a very similar way, this is how we look at our pressure indicator. When the lines converge, diverge, and intersect, we get foresight into coming changes in the direction of the market. When a trader becomes well versed in reading the pressure indicator, you're able to pick the most optimal times to enter a trade, or remain in a trade, or get out of a trade. The pressure indicator holds a lot of secrets, right? And the more adept we get with it, the more versed we get with its nuances, the more effectively we can trade with tighter risk to rewards, right? So not as much drawdown for profit, better entries, so we can take, you know, a longer stride in the market, and so on. Now, these are disciplines. Some of the more advanced aspects of the pressure indicator are disciplines that can take a very long time to learn. So in the meantime, we have exercises and setups, like systematic setups, that you can use to not only learn how to use the pressure indicator, but also to trade with it without having to learn everything about it. Okay, so let's get to our charts here, and we'll work through our exercises for today. Okay, so we've got, let's look at just the 60-minute. And let me just tighten this up a little bit. So we're going to look at just the 60-minute. And 1, 2, 3, 4, 5, 6, 7, 8. All right. Now I'm going to get rid of these candlesticks because I want to just focus on pressure. So let's go. Blank. There we go. Okay, so we got no candlesticks. All we're looking at is the pressure indicator. Let's just go back somewhere. Now, we're going to mark off a couple of things here. One, we're going to mark off, and I'm not going to go too nuanced, so there may be some that would qualify, and I might point them out, but we're not going to mark them off. What we will mark off is when the lines are pointed up. And actually, let's go back to when they first started pointing up. So when they first point up, right? So here they're pointed down. Right there, they first began to point up together, okay? And the other is when they cross. Ooh, and we're actually going to mark this one as well. So we'll do that one, green. We'll do convergence. We'll just do blue. And then when they actually cross, we'll do, let's just say red. So green, blue, red. We want to see one, when they're pointing, whether it's up or down, so when they first start pointing up or they first start pointing down. Two, when they converge, so you can see that if we extended these lines out, they would cross. So they're converging. And this is obvious conversion. Sometimes it's very subtle, but that's obvious convergence. And then when they cross, like that. Green crossed on bottom of red right there. You can see the intersection. Okay. All right. So we're going to go forward and just make some lines this way. So right now, they're both pointed up. So let's do this. Let's add one more thing. Let's say that when green crosses on bottom, we want to see when they point down. And then when green crosses on top, we want to see when they point up. And then we want to mark the conversion as well. So we're not going to mark this one because green crossed on bottom and they're not pointed down yet. So they're pointed up, not going to do it, not going to mark that one. Not that it's not useful, I just I want to do this in a way that's going to be palatable for you. Okay, there. So now it's pointed down, and that's going to be, yep, our green line. Okay. Good. It was already pointed down, so we're not going to continue to mark it because it's pointed down. Okay, there's that's slight conversion. Okay, we'll leave that one alone for now. Okay, still pointed down, no crosses. Okay, here's a cross, and they point up, right? So there, but we'll also dash it just because they did them both things simultaneously. They crossed and pointed up simultaneously. Okay, so now it's more sideways, sideways. Okay, pointing up, but we already marked it after they crossed and pointed up, so we'll keep going. Okay, we'll look for more obvious convergence. I'm gonna mark this because we're getting pretty close, but I'm gonna dash it just so we can go back to that and I can kind of show you guys what we're talking about there. Okay, so it's not going to count as a convergence, but because it's not as obvious as I want it to be. But I do want to go back to it. Okay. That's a little better, but let's look for something more obvious in terms of convergence. Okay, cross. So there's our cross. Now we want to see when they point down, right? Because green's on bottom now. Green's down, red's up. They both start pointing up again, so that we're not looking at that. Still, they crossed up and they're pointed up, so we'll mark that one for the cross and pointing up. And it crossed down, it crossed below red, right? So it kind of went back and forth. Crossed above, then crossed below. It's probably announcement, something like that, something crazy, right? That's usually what happens when we see some of this. Okay. And then we want to wait for it to point down. Oh. That's positive. We'll just leave that. So they never really get to the point. There we go. I was just going to say, they never really got to the point where they pointed down after the cross below. Okay, so right here we have them pointing down. And we'll leave that green. That's really sideways. I mean, obviously, if we drew lines from here and there, we could see that we could get some, crossover. But let's mark it just because it's simple to identify as convergence. Although, the whole idea of convergence is that they're converging closer together. We're here, obviously they are converging closer together and they're in a path to cross. There's still some separation, but we're not going to get into that much detail today, because although these could still cross, sometimes that divergence, that separation causes for there still to remain very low volume, low level movement in the market. And so sometimes it's not even worth, trying to trade on it, because you may be sitting around for quite some time waiting for your trade to fill. Okay, so let's, so that one is a lot more obvious, but let's stay with the one that we marked. Okay, so yeah, these are pointed down, but we already kind of marked when green crossed on bottom, pointed down, so we'll leave that one alone. Okay, not going to mark that. Okay, let's mark this one. Because again, we can see that convergence, right? Right there is probably even better. So we'll come back to that one. And there's the cross. And then let's see when they point up after the cross. No, we'll wait. Okay. So there's the pointing up after it crossed on top, right? So back here, it crossed on top. So it's on bottom right there. It's on green's on top now. And then they don't start pointing up until here. Okay. Whoa, went too far. There we go. That one's, I'm going to mark it. It's a little premature, but yeah, I'll mark that one because I want to go back to some of those and show you guys some of this stuff. That one's going to be a lot more obvious right there. And then there's the cross. And see when they point down. Red's up, green's down. Red's still kind of sideways. There we go. Okay. Oh, I'm going to open a can of worms for myself here. Okay, let's go back and look at some of the examples that we have so we can better understand what this exercise is all about. Okay, so let's start here, and I'm going to add some candles. Actually, I'm going to go ahead and throw on the indicators and then add some candlesticks. All right. So what were we looking at? Well, by itself, pressure is great for picking up some of those nuances, and you can lead with pressure. But by itself, a lot of times it's not enough. It's not enough just to have pressure. Sometimes you want to have pressure with another indication, major, minor, TNTs, something else. Fortunately, these are the fastest indicators in the industry. And of these, the pressure is the fastest to pick up predictive aspects of the market, right? Or give predictions for the market. But it's nice to have a second to say, okay, this is going to be a lot more solid, and it's more likely to green cross on top or point up or whatever that may be. So let's go to our first example here. So as we trek along here, you see major and minor kind of moving up the channel, and right there they start to point up. Okay. Now, if we were waiting for them to point up, and there's oh man, there's so much here. So I'm going to try not to overcomplicate this, but if we were waiting for them to point versus back here when we got, across the cross, or even back here when we got the convergence, right? If we're looking from right here, let's say, where the convergence happened, versus right here where they actually started pointing up, I mean, we caught some action right there, right? About 8.8 pips. Considering that the market only moved from this low end to this high end, 14.4, and that's from the very lowest to the very highest, taking more than half of that is really awesome, right? Especially seeing that prior to that, we had these little down pushes, right? Down pushes, and then we start to see movement in the other direction. And then here, finally, the green and red lines point up, right? And there's some other validation in there, but we're not going to look at everything about this. But notice that even before this happened, we were getting indications of what was coming, right? And then right here, as they point up, as they start to point up, we get a little bit of movement up still. We do get some down movement as well. Now, for those of you guys that have, been here for a while, I'm sure you guys noticed this, which is a head fake. And if you guys have not been here for a while or are not one of our members, you might not know what a head fake is, but there's actually a video on the YouTube channel on the head fake. And so we would actually have been expecting a long trade right there. And then after that, this double confirmation actually would have told us to sell. And so even though this is pointed up, we weren't really looking, again, if we're using the full picture, everything that we have in our repertoire, then we wouldn't have been using this to justify a long trade, right? On the contrary, we would have looked at the whole picture and said, actually, it's going to go short, right? Okay, so let's keep going here. Where was that one? Okay, right there. All right, so now let's look for our next one. So right here, okay, we get this obvious convergence. Now, and I'm sure I marked one off because I think I dashed it, but we can see right here that there's convergence already happening. But it's not as obvious if you haven't practiced with this, which is why I'm kind of leaving those off the table. So for those of you guys that are here that have done this exercise with me before or are aware of this, you might be wondering why I'm not including some of these, right? Well, that's because I want to make sure that it's palatable to everyone that's on this session, not just those that have had the opportunity to use these indicators for for more than a few months. So right here, that one becomes more obvious then, right? And right there we get the cross. And then we don't start to point down until there, right? So you can see that, and again, I think we're just looking at really low volume times right here, but you can see that at the point where we saw the convergence, which, I mean, we're not going to use this example, so we'll just use this one. We started to move short. We started to move south, right? And then the cross occurred, and it went a little sideways and then continued to move south. And then finally they pointed down right there. So you can see there's still some value in them actually pointing down, especially when you compare it with what major and minor are doing. If we go back, we can kind of see the same thing here where major and minor are starting to point down, and we're getting that convergence. So we're getting enough validation to validate that we're going to see some down movement. And then that continues. Okay, so let's look at, so we'll look at that one right there, did both, right? Green popped on top, and they both pointed up, and major and minor are pointed up. Now, a lot of times when we see this kind of stuff happen, this is like a knee-jerk reaction to the market. Sometimes a result of a market open or an announcement. So you can see we had some negative convergence. We had these lines converging, like one was going to start rolling over on top of the other, and we kind of had a soft up right here. I mean, this is almost a head fake where we'd be expecting a short trade on the next candle. Okay, but then we get this happen where everything just abruptly moves in one direction. And in one of our mastermind sessions, for those of you that are our mastermind members, you remember us talking about these abrupt movements a couple weeks ago. And sometimes the result of emotion in the market, new markets opening up, their banks start to open up at different times around the world, or an announcement. But you can see that it actually went, let me adjust that. Nope, not a lot of wick and shadow. So it actually retraced a good 4 hours. Let's see, that's about 5.3. I mean, more than 4 hours, because a lot of that market was sideways, right? So like a good 8 hours, it retraced in one candle. So that's new volume and liquidity in the market as a result of something emotional or a market open. And you can see right here, this is UTC 0200. And so, you can kind of go back for your time zone, which I'm offset by 6 hours because I'm Mountain Standard. So there could very well have been some type of open happening, market open happening, or announcement happening, or something that would, cause for that increase in liquidity, and we get that spike. So I say that to say this is telling us what the market is doing, just based on what happened there, not what it's going to do. So although there's some predictive natures in the indicators, nothing and no one can predict announcements or anything emotional like that. Matter of fact, let me just take a sidebar here for just a moment and point something out that happened this week. So I'm going to go to Forex Factory. For those of you guys that were paying attention, on Wednesday, this is June 16th, 2021, this was Wednesday, right, 2 days ago, the FOMC had their fund rate decision, right? Okay. So if the federal fund rate is increased, that strengthens the dollar. It makes the dollar stronger, which is why they didn't, because if you make the dollar stronger, then you hurt the economy, right? Because it's hard to get loans, it's hard to, just a lot of factors that would cause for this number increasing, the federal fund rate increasing, to hurt the economy. So they kept it the way it was, which means technically it hurt the currency. Technically, it didn't directly, because we didn't decrease the number, but by not increasing it, it continues to damage the currency, right? So for the sake of the economy. Okay, by definition, that's what that means. If this is increased, then the value of the dollar increases. If it remains the same or decreases, then either there should be no effect on the value of the dollar, or it should be or it will be a negative effect on the value of the dollar, right? Okay, so this happened at 12:30 my time on Wednesday. So let's go to our charts. And let's go to let me link these really quickly. Let's just go to the euro. Okay. So we're going to go to 616, and right here you can tell where it happened. Right here is where it happened. Right there. Let's see, 616, that's 17. Yep. So right here. That's where the announcement came out. Okay. Now, for those of you guys that don't know, if this is U.S. is listed second, then when this goes down, the U.S. is strengthening versus the euro. If this goes up, then the euro is strengthening versus the U.S. Okay? So right here, we did not increase interest rates, and the market, the U.S. dollar, strengthened on the euro USD, right? Let's look at GBP USD. At the same time, GBP USD. Now again, USD is the second listed. So if this goes down, the US dollar strengthened versus the Great Britain pound. Right? Oh, by the way, there's our half top. Just a random one. That one would have been fine. Okay, USD Swiss franc. So let's go to USD Swiss franc. right there is where it occurred. Look at that. That went up because it is the first listed on this currency pair. If this goes up, that means the US dollar is strengthening versus the Swiss franc. If it goes down, that means the Swiss franc is gaining strength against the US dollar, right? Just like here, this is second listed. US dollar is second listed. So when this goes down, the US dollar is strengthening. When this one goes down, the US dollar is strengthening. When this one goes up, the US dollar is strengthening. You see a pattern happening? Even though we were supposed to stay stagnant or lose value in the US dollar, it gained value. Let's look at USDJPY, another USD currency pair, right? This is going to blow your mind, guys. The reason why is going to blow your mind. Look at that. USDJPY. Again, USD is first listed. So it strengthened against the Japanese yen. So the US dollar got stronger across the board. These are major pairs. The US dollar got stronger in spite of the fact that by definition it should have remained neutral or weakened. So why is it that it went stronger? Because the banks knew that all the retail traders were going to look at the news, and everybody knew that the FOMC was not going to increase interest rates, which meant that the US dollar was going to lose strength, which means that all these sucker day traders that don't know any better decided that they were going to short the US dollar. Now, we're in a zero-sum market. It's a zero net market. That means that in order for there to be buyers, there has to be sellers. In order for there to be sellers, there has to be buyers. In order for the banks and the big hedge funds and the institutions to put in big old fat trades in one direction, they need a whole bunch of traders doing the opposite. Okay? They knew that all these traders were going to do the opposite, that they were going to try to short the US dollar. They were going to try to short the US dollar on all fronts. And so when that happened, what did they do? They got their big old bags of money and they went long on the US dollar because now they have a counterbalance to that. They don't have to say, oh, well, the FOMC didn't increase interest rates, so the dollar has to weaken. Nope. They get to do whatever they want in the markets. If they know that the retail trader is going to go based on some stupid, ridiculous notion that because an announcement said something that the market is going to move in that direction every single time the announcement does and says something that is supposed to reflect positively or negatively for that currency pair, right? That's not the way it works. It's a zero-sum market. All that means is that if I know that if I know that there are thousands of traders out there that are going to do something that is going to potentially move the market in one direction or another, maybe even millions of traders, right? And I have the ability, I have this huge multi-billion-dollar leverage, and I can put in huge trades and do the opposite of them because now they're carrying in enough as a collective to push to cover my trade, right? So one or two individuals may have only lost a little bit, but as a collective, it's billions, maybe even trillions, right? So again, we don't trade announcements. We don't do anything. It's called selling the rumor, right? And you guys can look that up, right? They know that traders believe that the market is going to do a certain thing based on how the announcement comes out. And so they let them believe that because it gives the big institutions the opportunity to do the opposite and take your money. And we've talked about this before. We've talked about it long before Wednesday on multiple occasions. You can go back to our videos. We've talked about, multiple occasions we've talked about this. And here we saw an example of it. So I love that because the proof is in the pudding, right? When we can see it actually happening, it's like, holy cow, it's true, right? So our indicators give us a very competitive advantage. But in situations like this, and like the one we just explained, there is no advantage to anyone except for the banks. No advantage at all. No indicator, no technical, fundamental analysis, nothing is going to help you in that situation, because everything in that situation, the one we were just looking at with the FOMC, that would have told you to short the US dollar on all fronts. Short the US dollar, right? Sell it. And it did the opposite of that. Nothing can help that because we have no idea when the banks are going to do that and when they're not going to do that. So we stay away from announcements. We stay away from that because it's a sucker bet. We don't do it. Okay, let's look at the rest of our examples here because we're running out of time here. Okay. So right here we saw that narrowing. I wanted to point that out because we had seen some examples like this, so I dashed it because it's not the example that I want to show you or explain to you. And you know, if you have the indicators to practice, and if you don't have the indicators, sign up for the free trial, guys. It's free, and you have the indicators. You'll be able to practice this stuff and see that it's as legit as we say it is, and we're not just making this stuff up. Okay, so let's go to this one here, and we got some more narrowing, but right here we get the cross. We actually didn't make a mark for our convergence, right, until at all, and then we made a mark for our cross. But we already started to see leading up to that we're starting to get that convergence, negative convergence. Now that doesn't mean that we're going to act on that, right? And we can see right here that we're still going to get some play, in the upward direction. But right here, in combination with those lines narrowing, even though they're parallel, so you want to watch out for that sometimes. So they don't look like they're going to intersect quite yet. But in combination with that and the fact that we've got that double confirmation up, then we start to expect that we're going to see some type of retracement. Some type of retracement. And there's a little bit right there, not much on that initial candle. 5.2, and it moved 4.8 up still. But you can see that we were already starting to see that there's a change coming. Okay, and if I stretch this out, we can see that we had very consistent movement, and these don't look very big because they're scaled, but you can see we had consistent movement up, and then we started to see the change, and then in just looking at the majors in combination, major and minor in combination with the pressure, especially right here, that double confirmation up, then we knew, okay, now we're going to start seeing some pullback. So if we're planning to take a buy trade into some of that buy movement, perhaps that gives us some pause to say, let's wait for the pullback. Or if we're planning to short or sell, then we're saying, okay, now we look for our entry. We're seeing the convergence. Now where's our entry? Right there, right? So depending on how you would have been trading that at that time, you could use it in both directions, in both ways. Should I take a trade now for the buy side, or should I take a trade now for the short side, right? Or should I just get out of the trade that I'm currently in, whatever it might be, right? But we're getting that indication way back here. And then let's see where our next example is. Right here, so we dashed and dotted it because green popped on top and they're both pointed up. Now there's some stuff here, right? Like, again, we got that double confirmation. So we're not going to look at any of that. Let's go to our next example. And just to clarify, when we say double confirmation up, we're not saying that it's double confirmed to go up. We're saying it's double confirmed overbought. So it's vastly overbought. It's more likely to pull back to the short side than it is continue to the long side, which is why we have this in addition to this to tell us, is this good? Because this would be absolutely awesome, green crossing on top right there, and them being very tight together like that as green crosses on top, if it was down here, right? If these looked like this, because then it's like, yeah, we got mountains of room. That's a solid big trade going up, right? But because we're already vastly overbought, we expect some pullback. even if it's just momentarily, like that. And then we got another cross right there in pressure. And then as it crosses down, we want to wait for it to point down, right? So look at all this action that we're missing out on as we're waiting for it to just point down. Right, so its real value is more in that it narrows at certain times, or crosses at certain times, diverges, converges, you know, all that kind of stuff. There we go. Now it's pointed down. And really, I mean, that took so long that it's moot. This is not even like a continuation of when we first saw it cross below red. But now it is pointed down. And did we get anything on that? No, not really, right? So you can see that aspect of it, although useful in some instances, is much more delayed than some of the other nuances of the pressure indicator, which is why, for example, with dirty pressure, all we want to see is when the green line crosses on top of the red line. That's all. We don't care if it's pointed up or down or sideways. Just the moment that the intersection happens, and then these lines are agreeing. So if green crosses on top, these lines, all four lines point up. Or if green crosses on bottom of red, at the intersection, all these green lines point down at the same time on the same candle where the intersection occurred, right? So you can see that even in some of those systematic ways of looking at it, it's more valuable to look at the crosses or the convergence to divergence than it is the direction that it's pointed. So back to that pressure gauge analogy, right? It doesn't matter if the arrow was pointed down. If it was pointed down to the left where the L was, it was low pressure. If it was pointed down to the right where the H was, then it was high pressure. So the direction that it was pointed was not as relevant as what it was pointed to, right? So same with this, with the pressure indicator. It's not as relevant where it's pointed as much as what it's indicating when it crosses or when it narrows or diverges and separates, right? So right here, we marked it because it is, you know, kind of that example of the trajectory, even though we have that a lot of that divergence, separation, right, which more causes sideways than anything. And we actually get sideways right there, 7.3 pips, but it also moves up, 6.7. And more sideways just because of that divergence. Right here we get some more convergence. It's not as clean as I wanted to show you guys, because, you know, again, if we drew lines here, they could still stay parallel to each other and not cross. But let's just start with that, because I think there's another one soon that we marked as well. Yeah, right there. So a lot clearer example. And then right there we get the cross. Which really didn't do much for us in that example. 3.4, and then it started moving down again. Okay, right there. Now it starts to point up, right? And so you can see that it's a lot cleaner when majors and minors are starting lower in the field, right? They're oversold right there. And now they're pointed up, overbought. And again, this could be one of those situations, just looking at it, this could be one of those situations where it's more emotional, right? There's something emotional that occurred, a market open or, you know, an announcement or something like that, because of that abrupt change in direction. See, majors are sharp down, pressure is leaning down, and then kinks right there, and then majors and minors pivot and start pointing up more aggressively. And obviously it's perceived with a larger candle than what we had been seeing in the previous, you know, 4 or 5 hours or so. And obviously we couldn't see any of that stuff. We couldn't see major, minor, we couldn't see candlesticks. We were just going based off pressure. You can see that the divergence and convergence and crossing get better results than just the direction it's pointed. And we're just scratching the surface with what I'm showing you here right now. I mean, this doesn't do it justice, but it's a start. So as you start to practice with our indicators, you get a better idea of how you can, grow into certain indications and start opening your eyes a little wider while practicing with some of these very simple ways of approaching the pressure indicator, and knowing that some of those seeds that are planted today will eventually kind of come to the forefront of your brain, and you'll start to realize these nuances, and certain things will just stick out to you. There'll be aha moments, and you'll be like, okay, now I'm starting to see it. Now it's starting to develop for me. And once that happens, it's over. For those members, for those students that really focus on pressure, their growth as professional day traders is it's just multiplied once they get those aha moments. And they could be doing really well for a long time just at the status quo without mastering some of these things, right? Really well. I mean, we've got people that use the really basic, simple stuff and clear 6 and 7 figures, right? Just plain trading with patterns, never branching out or deviating from it, and doing really well. But in terms of the understanding the indicators and being able to place a trade at any given time, a number of things, having that dynamic of pressure, you see that those leaps and bounds in their evolution once they unlock some of those nuances of pressure. And then it just opens up this can of worms for them, and they just want to dig in and figure out everything about the pressure. But of course, there's always a starting point, which is why we do these pressure exercises, or we have systematic trades like the clean pressure and dirty pressure, and a number of other ones that utilize some of those small nuances of pressure, but aren't necessarily you don't necessarily have to have this in-depth understanding of the pressure to utilize it, because it's very clear, right? When green cross is on top, and that's it. But we point out why that's important, and then it starts opening up that can of worms and start to realize, more effectively those nuances. All right, guys, that's what I have for you today. Again, if you guys haven't already, sign up for this is going to go away, guys. We're not going to do this for much longer, our free Trader Lite trial. And so get enrolled with it. Now, if you guys get signed up with it, we want you to be serious about this. If you're just curious about it, we're probably not going to spend a lot of time with you. We're just going to go through the motions. If you're just curious about things. If you're serious about making money at day trading, this is the program that we use to vet people to figure out which ones we want to choose to trade our corporate funds, okay, and do the next level coaching and go through 6 to 9 weeks of one-on-one coaching and get a funded account. This is how we decide which of you we will choose for that. And obviously, this is how you decide if you want to choose us, if you like us. All right, so if you haven't done this yet, do it. Get signed up for it. It's absolutely free. So do it. See if we are everything that we say that we are before we even start talking about what the next steps are. Okay? So check it out. There's a link in the description. And, of course, if you have any questions beyond that, you can always reach out to us, info@daytradesmart.com, or on Facebook or any of the other social media places that we are. For today, happy trading. Have a good weekend. We'll see you guys